Imagine a single company needing the entire electrical output of 3 nuclear power plants just to turn on their newest product.
Yeah, not to manufacture it, right, just to plug it in.
Right, literally just to plug it in and turn it on. I mean, that sounds like a pitch for a science fiction movie.
Oh, completely.
But that is the actual, contracted reality of Meta's new artificial intelligence infrastructure deal. 3 gigawatts of power.
It's staggering.
And they are just one customer. We're looking at a landscape where the old metrics like measuring sales in units or dollars are starting to feel, well, kind of quaint.
Yeah, they really are.
We are now measuring corporate growth in raw planetary scale electricity.
It forces a complete recalibration of how we understand hardware.
Definitely.
I mean, when your customer needs to secure enough power to run a medium-sized city just to utilize the product you're selling them.
Right, like an entire city.
Exactly. You're no longer operating in a traditional supply and demand cycle. You're dealing in, well, structural macroeconomic infrastructure.
Welcome to a special Talk Tickers edition of our deep dive. Our mission today is laser focused.
Yep, getting right into it.
We are taking the mountain of data from Broadcom's staggering Q2 2026 earnings call. That's ticker symbol AVGO, by the way. And we're going to extract the signal from the noise.
There's a lot of noise out there right now.
So much noise. So we're bringing you the data. We're bringing you the plain language translation of all that boardroom jargon. And, we're going to be heavily opinionated about what this actually means for your investing strategy.
Because the narrative buried inside this specific transcript is, well, it's arguably the most important blueprint we have for the physical reality of the AI revolution.
Absolutely. But before we hit the raw financial data, I want to address a major changing of the guards happened on this call.
Oh, right. The CFO transition.
Yeah. Kirsten Spears, who has been the chief financial officer for the past 12 years, is retiring.
12 years?
Yeah, 12 years. She's handing the reins over to Amy Tiener. I mean, 12 years as a CFO in the tech sector is basically an eternity.
It really is a profound legacy. I mean, if you look at Broadcom's trajectory over the last decade, it's been defined by these massive, highly complex acquisitions.
Like Symantec, right?
Right. Symantec's enterprise security business, CA Technologies, and of course, most recently, the colossal $69 billion acquisition of VMware.
Just massive deals.
Exactly. And Kirsten Spears basically engineered the financial architecture that allowed Broadcom to digest those massive companies.
Right, to strip out the inefficiencies and turn them into like cash printing machines.
Yeah, all while navigating global supply chain shocks and a once-in-a-generation pivot to artificial intelligence.
So Amy Tiener is stepping onto a ship that is already operating at maximum velocity.
Totally.
And speaking of velocity, I'm looking at these Q2 top-line numbers, and the scale is so massive it almost feels like a typo.
It really does.
Total Q2 revenue came in at a record $22.2 billion. That is up 48% year over year.
48%.
I mean, how does a mature mega cap company, one that is already a titan in the industry, grow its top line by 48% in a single 90-day period?
Well, the law of large numbers usually prevents that kind of acceleration, right?
Exactly.
But it requires this perfect storm of legacy stability and frontier hypergrowth. If you dissect that $22.2 billion, you see 2 distinct businesses operating under one roof.
Okay, break that down for us.
First, you have Semiconductor Solutions, the hardware side. That segment hit $15 billion, which is a 79% increase year over year.
And the engine behind that 79% jump is purely artificial intelligence, right?
Oh, yeah.
Because they reported a record $8.3 billion in AI revenue alone, which is up like 143% from last year.
That is the jet fuel, without a doubt. But we really have to look at the other side of the house, which is infrastructure software.
Right, the VMware side.
Exactly. That came in at $7.2 billion, up 9% year over year. And what Wall Street really cares about there is the annual recurring revenue, or ARR.
Which grew by what, 17%?
Yeah, 17%.
Let me stop you there for a second, because we throw around terms like ARR a lot.
Sure.
But for someone managing their own portfolio, listening to this right now, why does Wall Street place such a huge premium on that specific metric in software?
Well, annual recurring revenue is basically the holy grail for investors because it represents predictability.
Okay.
It's the subscription money that is contractually guaranteed to arrive every single year, regardless of the macroeconomic environment.
Right, whereas a chip is just a one-off.
Exactly. When you sell a physical microchip, that's a one-time transaction. You get paid once, and then you have to go find another customer tomorrow to keep your revenue up.
That makes sense.
But with enterprise software, once a massive corporation integrates your software into their daily operations, like they do with VMware to manage their cloud servers, they pay a massive licensing fee every single year.
So a 17% growth in ARR means Broadcom's baseline guaranteed floor of revenue is rising rapidly.
Yes, it acts as an anchor for the whole business.
Wow. So we have this massive top-line growth, and the cash generation is just absurd.
It's unprecedented.
Free cash flow was $10.3 billion. That means 46% of every single dollar that came in the door ended up as free, unrestricted cash.
It's a staggering margin.
And their adjusted EBITDA hit a record 69% of revenue, translating to $15.2 billion in a single quarter.
We should probably clarify EBITDA for anyone newer to analyzing earnings reports.
Yeah, good idea. Go for it.
It stands for earnings before interest, taxes, depreciation, and amortization. Essentially, it strips out all the accounting maneuvers and the tax structures to show you the raw, core operating profitability of the business itself.
A 69% EBITDA margin at a $22 billion scale. I mean, it almost defies gravity.
It really does.
They're generating so much cash, they ended the quarter with $19.6 billion sitting in the bank.
Yeah.
And that is after they paid out over $3 billion in dividends to their stockholders.
It's a cash cannon.
But I have to play devil's advocate here for a minute.
Bring it on.
I'm looking at all this phenomenal growth. I'm looking at the cash flow, but there is a flashing red light in the transcript that, well, algorithmic trading bots immediately panic over.
The gross margins.
Yes. Broadcom's gross margins declined to 77.2%. Now, if revenue is up 48% and they're selling the most advanced AI chips in the world, chips that everyone assumes have massive pricing power, why on earth are their gross margins compressing?
All right.
Are they having to discount their hardware just to win deals?
See, that is the exact trap that retail investors fall into if they only read the headlines.
Okay, tell me why I'm wrong.
The margin compression has absolutely nothing to do with discounting or losing pricing power. It is entirely a function of product mix.
Walk me through the mechanics of that. What does product mix actually mean in this context?
Think about the two businesses we just discussed. Software, by its very nature, has an astronomically high gross margin.
Right.
The gross margin is simply the revenue minus the cost of goods sold, so the physical cost to deliver the product.
Yeah.
Once a team of engineers writes the code for VMware, the cost to copy that code and send it to the next customer is functionally zero.
So selling software is basically selling highly intellectual air.
Precisely. Because of that, Broadcom's software division operates at roughly a 93% gross margin.
Wow. Okay.
Now, look at the hardware side. Semiconductors are physical objects. They require incredibly expensive silicon wafers from foundries like TSMC in Taiwan.
Yeah, and rare metals, advanced packaging.
Exactly, and massive fabrication plants. Even with the best pricing power in the world, the physical cost to manufacture our microchip is substantial.
Okay, so what's their margin on the hardware side?
Broadcom's semiconductor gross margin is around 70%, which, by the way, is a spectacular margin for physical manufacturing.
Yeah.
But mathematically, it's obviously lower than 93%.
I see the mechanism now. It's a weighted average problem.
Exactly. Broadcom's 70% margin semiconductor business is growing at 79% due to the AI boom.
Right.
While the 93% margin software business is only growing at 9%.
So because the hardware business is suddenly taking up a much larger slice of the total revenue pie, the weighted average of the entire company gets dragged down.
You nailed it.
It's like, imagine a massive restaurant franchise. Let's say you sell sodas at a 90% profit margin, and you sell premium steaks at a 60% profit margin.
I like where this is going.
Your overall profit margin looks amazing because people buy a lot of soda. But suddenly, a convention of powerlifters comes into town and orders 10,000 premium steaks.
Right.
Your overall profit margin percentage is going to drop because you sold so much meat, but your actual bank account is going to be overflowing with cash.
Exactly.
You don't get mad that your margin percentage dropped. You celebrate because your gross profit dollars just exploded.
That is a brilliant way to visualize it.
Yeah.
You take gross profit dollars to the bank, not gross profit percentages.
Right.
And the transcript explicitly addressed this to calm the market. They pointed directly to their operating leverage.
Okay, so what is the difference there? How does operating margin save them from the gross margin drop?
Gross margin only subtracts the cost of the raw materials. Operating margin subtracts everything else, the corporate overhead, the real estate, and most importantly, the massive research and development budgets.
Because they spend a lot on R&D.
Oh, a ton. Broadcom spent $1.6 billion on R&D this quarter alone.
Wow.
That sounds like a lot, but this is where operating leverage kicks in. The fixed cost to run the company didn't spike by 48%, just because revenue spiked by 48%.
Right, because once you pay a team of electrical engineers to design the blueprint for the world's fastest networking switch, that blueprint is done.
Exactly.
If you sell 1 million switches, or if you sell 10 million switches, you don't have to hire 10 times as many engineers to design it all over again.
Exactly. The R&D is a fixed upfront cost. So as that massive wave of hardware revenue comes in, the cost of the raw materials is accounted for in the gross margin, but all the rest of the revenue flows straight past the fixed R&D costs and drops right to the bottom line.
That is incredible.
Yeah, that is why their actual operating margins remained incredibly stable at 67%. The core profitability engine of the business is fully intact.
That is a massive, actionable takeaway for anyone analyzing this stock right now. If you see headlines screaming about Broadcom's margin compression, you can confidently ignore the noise. Just focus on the operating margin stability.
Completely agree.
Okay, let's pivot slightly because we really need to understand what is actually driving this tsunami of hardware sales.
Yes, let's get into it.
AI is the ultimate buzzword right now, but Broadcom is dealing in the hardcore physical reality of the technology. And the most shocking metric in this entire earnings call was the backlog.
Oh, the backlog numbers were wild.
Broadcom reported that their bookings for AI semiconductors in the second quarter were over $30 billion, but they only shipped $10.8 billion.
Yeah.
That is nearly a 3-to-1 ratio of orders to shipments.
We really need to define what a booking actually is, though, because it's not just a casual conversation with a customer.
Right, it's not a wish list.
Exactly. A booking is a firm, non-cancelable order. The customer has legally committed to purchasing that hardware.
Wow.
When your bookings are nearly triple what you are physically capable of shipping out the door in a single quarter, you are staring at a structural backlog that guarantees massive revenue streams stretching years into the future.
So why is the demand that high? What exactly are they selling? Because, everyone immediately assumes AI chips means NVIDIA GPUs.
Right, that's the common assumption.
But Broadcom is dominating a completely different, equally critical part of the architecture. The transcript noted that networking components made up about 40% of their AI revenue this quarter.
Yeah, 40%.
Management expects that to normalize around 30% long term, but that is still a staggering amount of money dedicated just to networking. Why is the connective tissue suddenly taking up 40% of the budget?
Well, to understand that, we have to look at the physics of how large language models like GPT-4 or Claude are actually trained. A traditional data center might have thousands of servers, but they are all working on separate small tasks.
Like serving up a web page or processing a credit card transaction.
Exactly. They don't really need to talk to each other very much.
Right. They are working independently.
But artificial intelligence completely breaks that model. When you are training a frontier AI model, you are feeding it petabytes of data, the entire internet, basically.
Yeah.
One single microchip cannot process that. 10 microchips cannot process that. You have to use a cluster of tens of thousands of highly advanced chips, and they all have to work on the exact same problem simultaneously.
They have to act as one single massive distributed brain.
Exactly.
Yeah.
And to act as one brain, the left hemisphere needs to know what the right hemisphere is doing instantaneously.
Instantaneously.
Yeah. The chips have to share massive data sets with each other back and forth millions of times a second. If that data transfer is slow, the entire multi-billion-dollar supercomputer grinds to a halt. The incredibly expensive processors just sit there, idle, waiting for the data to arrive over the network.
I use an analogy to explain this to friends all the time.
Yes, here.
Imagine you go out and buy the fastest, most expensive sports car engine on the planet. That is the actual processor, the GPU or the TPU.
Okay, I'm with you.
But if you take that engine and put it on a dirt road filled with potholes, it doesn't matter how fast the engine is. You are going to crawl at 5 miles an hour.
That's a great way to put it.
Broadcom isn't necessarily selling the engine. They're selling the massive, multi-lane, perfectly paved superhighways that connect the engines. And they are selling the traffic control systems that ensure there are no traffic jams.
It is the perfect way to visualize it. And the highway construction is getting incredibly complex because of the sheer scale of the traffic.
Right.
Broadcom is taping out their new Tomahawk 6 switch this quarter.
Wait, Define taping out for us. That is a heavy piece of industry jargon.
Oh, sure. Taping out is the final milestone in the semiconductor design process. It means the engineering blueprint is 100% finished, and the final design files, which, fun fact, used to be sent to factories on magnetic tape, hence the name, are sent to the foundry, like TSMC, to actually begin physical manufacturing.
Ah, got it. So the Tomahawk 6 is ready for the factory. What does it actually do?
It is a 200 terabit per second Ethernet switch.
That sounds fast.
It acts as the grand central station for the data flowing between the chips. But it goes deeper than the switches. As these AI clusters scale up from 10,000 chips to 100,000 chips, or even 300,000 chips, the physical distance between the servers gets larger.
Right, because you're talking about buildings the size of multiple football fields.
And distance is the enemy of data transfer.
Because it takes longer to travel.
Exactly. Historically, data centers connected servers using copper wire. But copper has physical limitations. When you try to push 800 gigabits of data per second through a copper cable over a distance of more than a few meters, the electrical signal just degrades.
Oh, really?
Yeah, it generates heat, it suffers from interference, and the data gets corrupted. The signal-to-noise ratio collapses entirely.
So if copper physically cannot handle the traffic on these massive AI highways, what is the solution?
You have to move to optical interconnects. You literally have to translate the electrical data into light, shoot it through a fiber optic cable using lasers, and then translate the light back into electricity on the other side.
Lasers? Seriously?
Yes, lasers. And Broadcom is the undisputed king of these optical connective tissues. They design the lasers, they design the digital signal processors, the DSPs, which are the tiny chips that clean up the signal and do the complex math to translate the electricity into light and back again without any errors.
That is fascinating. So when a company like Meta or Google decides to build a supercomputer with 100,000 chips, they are basically forced to buy Broadcom's optical equipment because copper physically melts or fails at that scale.
They have no choice. The laws of physics dictate the networking budget. And Broadcom's mastery of open standard Ethernet networks is why they are winning. Companies like NVIDIA push proprietary networking solutions like InfiniBand.
Right, I've heard of InfiniBand.
It is incredibly fast.
Yeah.
But it locks the customer into NVIDIA's ecosystem forever. And the massive tech giants, Google, Meta, they despise vendor lock-in.
Naturally.
They want open standards.
Yeah.
Broadcom provides the highest performance Ethernet, which is an open standard, allowing these massive companies to maintain control of their own architecture.
Which brings us to what I consider the absolute wildest part of this earnings call.
Oh, I know where you're going.
This changes the entire thesis on the hardware sector. We really need to talk about the gigawatt metric.
Yes. This was the moment in the transcript where the paradigm truly shifted.
Totally.
For decades, Wall Street analysts have modeled semiconductor demand by looking at unit volume. Like how many smartphones will be sold, how many laptops, how many server racks.
Right.
But on this call, management barely talked about units. They started measuring their customer agreements in raw electrical capacity, gigawatts.
When I read that, I literally stopped and stared at the page.
It's crazy.
I mean, a gigawatt is not a tech metric. It is a utility metric.
Yeah.
1 gigawatt is roughly the maximum power output of a massive nuclear reactor.
Yeah.
Or like the Hoover Dam, which generates about 2 gigawatts. It is enough electricity to power a medium-sized American city.
It's hard to even wrap your head around.
And Broadcom's CEO, Hock Tan, just casually laid out their roadmap for their core customers using this metric. Let's walk through these numbers because they are terrifyingly large.
We can start with Google. Broadcom announced they have a long-term agreement to develop and supply multiple future generations of TPUs tensor processing units.
Those are Google's custom chips, right?
Yeah, right. Google's custom-designed AI engines. Broadcom partners with them to design the networking interfaces and manage the physical supply chain. This secures Broadcom's position inside Google's infrastructure for the foreseeable future.
Okay, and then there is Meta. Hock Tan noted they are deploying 3 gigawatts of compute capacity through 2028.
3 gigawatts.
That is more power than the entire Hoover Dam generates, dedicated entirely to Meta's artificial intelligence data centers.
Just from Meta.
And the initial order for the first gigawatt is already on the books and starts delivery in the second half of 2027.
The acceleration is what is truly breathtaking here. Look at Anthropic, one of the leading frontier model developers creating the Claude AI.
Right.
For 2026, they're accessing over 1 gigawatt of Broadcom TPU-based compute. But starting in 2027, they have signed an agreement to access another 5 gigawatts of next-generation compute.
5 gigawatts for one startup.
It's unbelievable.
And finally, there is OpenAI, the creator of ChatGPT. Broadcom is on track to put OpenAI's custom silicon into production late this year.
All right.
But looking ahead, they have a contractual commitment to deploy 1.3 gigawatts in 2027, and that is just the beginning.
Just the start.
The transcript explicitly stated this is part of a larger agreement with OpenAI to reach an astonishing 10 gigawatts by 2029.
10 gigawatts. 10 nuclear reactors worth of power for a single company's artificial intelligence.
It's insane.
The physical infrastructure required to support that is almost incomprehensible. You are talking about acquiring massive tracts of land, securing the water rights for industrial-scale cooling systems, building dedicated substations.
And potentially negotiating directly with energy companies to build dedicated small modular nuclear reactors just to keep the chips from melting.
Exactly.
I want to tie this back to my analogy earlier. If Broadcom is designing the engines and they're paving the optical highways, this entire gigawatt discussion means they are suddenly deeply involved in building the gas stations.
Yeah.
But wait, Broadcom makes microchips and software. They don't pour concrete. They don't string high-voltage power lines.
Yeah.
So how can a semiconductor CEO sit on an earnings call and guarantee 20 gigawatts of capacity for their customers? How is that even their business?
You have just hit on what is undeniably the most fascinating under-the-radar story hidden in this earnings call.
I thought so.
This is the financial engineering masterpiece that Wall Street is just starting to wake up to. Broadcom announced they are partnering with the private equity giants Apollo and Blackstone to launch a massive AI infrastructure platform.
Wait, why in the world is a chip designer teaming up with private equity? What does Apollo have to do with optical interconnects?
Think about the massive financial burden we just described. Building a single 1 gigawatt data center from scratch costs tens of billions of dollars in upfront capital expenditure.
Right, it's hugely expensive.
Even for a hyperscaler like Meta, or the most well-funded startups on Earth like OpenAI and Anthropic, pulling together $50 or $100 billion in cash to buy land, pour concrete, build power plants, and then fill the building with chips.
It's financially crushing.
Exactly. It destroys their balance sheets.
So the bottleneck to Broadcom selling more chips isn't their ability to design them or TSMC's ability to print them. The ultimate bottleneck is simply the customer's ability to afford the actual building to plug the chips into.
Exactly. Broadcom looked at the landscape and realized their customers were going to run out of money to build the data centers before they ran out of desire to buy the chips.
Oh, wow.
So Broadcom utilized their strategic position. They brought in Apollo and Blackstone firms that manage trillions of dollars for pension funds and sovereign wealth funds.
Right.
These private equity firms are launching a $35 billion platform right now as just the first tranche to deploy more than 20 gigawatts of compute capacity through 2028.
So Apollo and Blackstone are actually fronting the cash to build the physical data center.
Yes. They set up special purpose vehicles, or SPVs. The private equity firms provide the massive upfront capital to build the facility and buy the Broadcom chips.
Okay.
Then they lease the computing power back to Anthropic or OpenAI on a multi-year contract.
That is brilliant. It reminds me of the old General Electric model with GE Capital.
Well, that's a great comparison.
Yeah, GE realized that airlines wanted to buy their massive jet engines, but airlines didn't always have the cash on hand. So GE created a massive internal bank to lend the airlines the money to buy the engines.
Right.
Broadcom is essentially doing the same thing, but instead of using their own balance sheet and taking on massive debt, they outsourced the banking operation to Blackstone and Apollo.
It is a phenomenal comparison. The private equity firms love it because a massive data center with a 10-year ironclad lease from OpenAI is essentially a modern utility.
Like a toll road.
Exactly. It produces safe, guaranteed, long-term yield for their pension fund clients. Broadcom loves it because they completely de-risk their own revenue pipeline.
Because they get paid no matter what.
Yeah. They don't take on the debt of building the facility, but they guarantee that the customer will have the infrastructure ready to buy billions of dollars worth of Broadcom chips.
Broadcom is literally engineering the financial reality that makes their own massive revenue projections possible.
They really are.
They aren't sitting around hoping the grid can handle their chips. They are orchestrating the capital to build the grid. That is next level corporate maneuvering.
It's masterful.
Which brings us directly to management's guidance for the future. In the semiconductor industry, which has historically been violently cyclical, boom and bust long-term promises are usually dismissed by analysts.
Typically, yeah. If a chip CEO tells you what revenue will look like 3 years from now, you smile and ignore it because consumer demand for PCs or smartphones can evaporate in 6 months.
But the data they are presenting here suggests a level of structural certainty that is incredibly rare. Let's look at the near term first.
Okay.
For Q3 2026, they are guiding for consolidated revenue of $29.4 billion.
Right.
That is an 84% jump year over year.
Massive.
Within that, semiconductor revenue alone is guided to $20.5 billion, up 124%. And the AI portion of that hardware revenue is guided to $16 billion, up over 200% year over year.
The acceleration is just violent.
It really is.
And it carries straight through the end of the calendar year. For the full year 2026, they expect AI semiconductor revenue to hit $56 billion, which represents a 180% increase from the prior year.
Wow.
If you look at the math, they did about $19 billion in the first half of the year, which implies they expect the second half to double that run rate. The momentum is building rapidly.
But here's the moment in the transcript where my jaw genuinely hit the floor.
I think I know which part.
Hock Tan, the CEO, looked past 2026 and gave guidance for 2027. Usually when a CEO is pressed about next year, they give you incredibly vague, qualitative corporate speak.
Oh, yeah. Like we see strong macroeconomic tailwinds.
Right. Or we remain cautiously optimistic about enterprise spending. Not Hock Tan. He explicitly reiterated hard financial guidance, stating that AI semiconductor revenue will exceed $100 billion in 2027.
Let that number sink in.
$100 billion.
A single product category, artificial intelligence networking and custom silicon generating over $100 billion in revenue for a single company in a single year.
It's absurd.
There are only a handful of entire corporations on the planet Earth that generate $100 billion in total annual revenue across all their businesses.
I am truly struggling to understand the visibility here. How can a hardware CEO sit in a boardroom in mid-2026 and confidently predict $100 billion in revenue for the next year and casually outline gigawatt deployments stretching all the way into 2028 and 2029?
Well, if we connect this back to everything we just discussed about the gigawatt power metrics and the private equity financing, the answer becomes obvious.
Okay, tell me.
It is driven by the physical constraints of the real world. If you're Meta and you want a 3 gigawatt data center operational in 2028, you cannot wake up in 2027 and order 100,000 custom networking switches on Amazon Prime and expect 2-day shipping.
Right, you are moving physical mountains.
Precisely. You have to secure the land today. You have to apply for the power permits and environmental reviews today.
That takes years.
Yes. You have to secure the liquid cooling infrastructure, the optical fibers, and most importantly, you have to secure your spot in line at TSMC to have the silicon wafers printed.
Right.
Because the construction of the physical power shell takes 3 to 4 years, the order for the chips that go inside it has to be placed 3 to 4 years in advance.
During the Q&A portion of the call, an analyst asked almost exactly this question. They asked why the $30 billion in bookings was so high relative to the $10 billion in shipments.
And Hock Tan's answer was telling.
Yeah, he basically said that their customers are terrified of being left behind. They realize that lead times for power generation dictate everything.
Exactly.
They are planning their chip orders based on when the concrete will dry at the power plant. That fills Broadcom's order book all the way out to 2028, providing a structural safety net that traditional consumer electronics simply never have.
It entirely inverts the traditional risk model of a hardware company.
Explain what you mean by inverting the risk model.
In traditional semiconductors, the ultimate terror is building too much inventory. If you build 10 million smartphone chips, and suddenly the economy dips and consumers stop buying phones, you are left with billions of dollars of useless inventory rotting in a warehouse.
And you have to write it off.
Right, and it crushes the stock. So chip companies usually try to keep inventory as lean as possible.
But Broadcom is doing the exact opposite right now. Kirsten Spears noted on the call that they currently have 86 days of inventory on hand, which is actually up from 68 days in the previous quarter. They are actively stockpiling.
Exactly. They are intentionally hoarding supply. They are securing every single wafer they can from TSMC.
Wow.
They are buying up all the high bandwidth memory, the incredibly scarce memory chips required for AI processors that they can get their hands on.
Because that massive $30 billion booking backlog guarantees that they will sell every single chip they can possibly manufacture for the next 3 years.
Yes. The risk for Broadcom is no longer a lack of demand. The only risk is an inability to secure enough raw supply to meet the insatiable appetite of these multi-gigawatt private equity-backed data centers.
That is just incredible. We have spent almost all our time on AI, which is understandable given the scale, but we should briefly touch on the legacy non-AI side of the house.
We definitely should.
Because Broadcom still makes traditional enterprise networking gear, broadband chips, and wireless components for smartphones. If that side of the business collapses, it could drag down the whole ship.
But it isn't collapsing. In fact, it is recovering. Non-AI semiconductor revenue came in at $4.2 billion, which is up 6% year over year.
That sounds small compared to the AI numbers.
It does, but the critical metric is that bookings in that traditional segment exceeded $6 billion. As Hock Tan pointed out, the enterprise networking market went through a brutal digestion phase where companies stopped buying gear. But that massive booking number is a clear, undeniable indication that the traditional market is on the path toward a full cyclical recovery.
The baseline is strengthening.
Exactly.
And we also need to hit the infrastructure software side again, because that VMware acquisition was a $69 billion bet. Software revenue was $7.2 billion, up 9%.
Right.
But the forward-looking indicator is massive. They are forecasting Q3 software revenue to jump to $8.9 billion, which would be up 31% year over year. What is the catalyst driving that sudden software acceleration?
The catalyst is the massive rollout of VMware Cloud Foundation 9.1.
Okay, what does that software actually do for an enterprise customer?
It solves a massive headache for chief information officers. Right now, companies are buying NVIDIA GPUs for AI, they are buying AMD chips, they are using traditional Intel CPUs for basic tasks.
Right, a mix of everything.
Managing all that different hardware in a private on-premise data center is a nightmare. VMware 9.1 software creates a unified layer that allows an enterprise to seamlessly manage heterogeneous compute.
Heterogeneous compute, meaning different chips from different brands all working together.
Exactly. It abstracts the hardware away, so the IT department can easily allocate workloads, whether it needs a GPU or a CPU.
Got it.
As global enterprise server demand rises to support AI integration into everyday business tasks, the deployment of this VMware software is driving robust, high-margin revenue growth. It acts as an incredibly stable cash-generating anchor, while the hardware side explores the absolute limits of physics.
We have covered a truly staggering amount of ground today.
We really have.
We analyzed the raw revenue beats. We debunked the gross margin panic by explaining the weighted average and operating leverage. We explored the massive structural backlog. We unpacked the physics of optical networking. And we broke down this unprecedented paradigm-shifting partnership with private equity to finance the power grid in gigawatts.
It's a lot to take in.
It is time to synthesize all this data. Let's get to the bottom line.
For the retail investor listening to this, the mandate is to translate all this technical and financial complexity into an actionable perspective.
And our format demands that we are opinionated. Based on the $22.2 billion top line, the wildly efficient 67% operating margins, the guaranteed $30 billion backlog, and the explicit CEO guidance for over $100 billion in AI hardware revenue next year.
Yeah.
The verdict here is overwhelmingly, unequivocally bullish.
It is genuinely difficult to look at these metrics, understand the physical supply chain constraints, and arrive at any other conclusion.
Right.
The fundamentals are pristine. But more importantly, the strategic corporate maneuvering to bring in Apollo and Blackstone completely neutralizes the biggest macroeconomic risk on the horizon, which was the fear that hyperscalers would eventually run out of capital expenditure budget.
Exactly.
By securing the private equity financing, Broadcom has paved their own runway for years to come.
Here is the actionable takeaway. If you currently hold shares of AVGO, that $30 billion booking backlog and the clear visibility into 2028 provides you with a massive safety net.
A huge one.
This is not a short-term, hype-driven software fad that could disappear in 6 months. The inescapable physical lead times of building nuclear-powered data centers mathematically guarantee this revenue stream. You are holding a company that is structurally locked into the growth of the entire artificial intelligence industry.
And for those investors who are on the sidelines looking at the stock and wondering if they missed the boat, you have to fundamentally shift how you categorize this company in your portfolio.
How so?
Broadcom is no longer just a traditional semiconductor designer or an enterprise software holding company. They've effectively transformed into the foundational AI infrastructure ETF.
I love that framing. Explain the concept of an infrastructure ETF to the listener. Why is it safer than trying to pick the winner of the AI race?
If you are an investor right now, trying to pick the winning AI software model is a fool's errand. The competition is a bloodbath.
Yeah, truly.
Will OpenAI's GPT-5 maintain its dominance? Will Google's Gemini deeply integrate into everyone's workflow and win out? Will Anthropic's Claude become the trusted enterprise standard? No one knows. But if you invest in Broadcom, you do not have to predict who wins the software war.
Because in a gold rush, Broadcom isn't mining for gold. They are selling the picks, the shovels, the reinforced steel beams, and they are building the railroad tracks to get to the mine.
Exactly. You aren't just buying silicon chips. You are buying the Tomahawk and Jericho networking switches that physically hold these massive supercomputers together.
Yeah.
You are buying the custom TPU processors that Google and Meta literally cannot function without. And now, through the SPVs with Apollo and Blackstone, you are buying into the financial architecture that makes the 20-gigawatt physical infrastructure possible in the first place.
It's all connected.
Regardless of which brilliant AI lab ultimately wins the algorithmic war, their software cannot physically exist without Broadcom's hardware and network architecture beneath it.
It is a remarkable evolution from a standard tech company to a foundational pillar of the next global economy. Which brings us to our final thought for the day. A provocative question for you, the listener, to mull over as you review your own portfolio and think about where the world is heading over the next 5 years.
I'm ready.
If Broadcom is no longer just selling microchips, if they are now orchestrating partnerships with Wall Street private equity titans to literally finance the multi-billion-dollar power and compute infrastructure for the world's most advanced AI labs, it begs a massive question about the future hierarchy of the technology sector.
Who really holds the ultimate power in this revolution?
That is exactly the question. Is the true power held by the companies writing the brilliant generative AI software algorithms, or is the ultimate power held by the hardware landlord, the company that controls the optical networks, designs the custom silicon, finances the physical buildings, and effectively owns the grid that allows that software to exist at all?
History tells us that the people who control the critical infrastructure eventually dictate the terms to everyone else.
The era of measuring tech companies by the millions of dollars is over. We are in the era of gigawatts, and right now, Broadcom is managing the grid. Thanks for joining us on this highly actionable Talk Tickers deep dive. Dive into your portfolios, look at the physical realities behind your investments, and we'll see you next time.